10-year Treasury note futures falter ever so slightly on the opening, and largely due to data coming out of Eurozone. We saw mixed to okay PMI numbers coming out across the continent. Both Eurozone and Germany were mixed with regards to PMIs coming out of France and also the UK. They actually were better than expected. Add on top of that just general trepidation over Friday's Jackson Hole symposium. Also, we have $209 billion of supply coming out this week. Tuesday, tomorrow, we have $60 billion of the 2 years, just enough to get the market just a little bit on the downside. Also, COVID headlines came out over the weekend. The 7-day average in the U.S. hit a 6.5-month high. Beyond that, nothing more worse than feared, as it were. Going into the middle of the session to the late of the session, there's a tight range. We did have some pretty decent data come out in the U.S. The July Chicago Fed national activity hit a 4-month high. July existing home sales also hit a 4-month high. And lastly, August market manufacturing PMI hit a 4-month low. So everything's in 4 months. Equity market had most of the day rally. We saw a ever so slight record high in the NASDAQ 100. Crude at one point up 4%, dollar down, gold up. All these things just keeping 10-year Treasury note futures in a mixed range, as it were. Now, going on to the CME Group CVOL, looking at options volatility, it seems right now that at-the-money volatility is down ever so slightly, and I'm talking about September. And by the way, looking at September on a 1-month or 3-month basis, trading at about the 40th to the 55th percentile. Skew in September actually is up, given that skew is to the call, and we're seeing call variance is up, put variance is down, causing implied skew to go up. Also, have to speak about the CME Micro Mini Treasury futures, yield-based, a week old as of today. They continue to trade more volume, more liquidity, and more open interest.